Have you ever wondered, what is a bond? And how is it different from a stock? We often hear stocks and bonds used together. What are the differences and what are the similarities? If those are questions that you have, stay tuned. I have some answers for you. Before I start on this video, I want to remind you that I have a free workshop that is available to you by clicking on the link in the description box below this video. It's about 90 minutes long. I'm not trying to sell you anything. I'm just trying to offer you some insight and different ways that I think, and to help you possibly think in different ways yourself. The coverage includes a lot of different areas. Of course, I talk about the financial markets in general and a little bit about the stock market itself. I also cover sports. I'm a big fan of sports. Music. I've been playing music since I was very young. And I also talk about professional and personal relationships. The goal of this workshop is to help you to think in either new or different ways, as well as for you to get to know me and my style. So just what is a bond? This is not meant to be an exhaustive video talking about all the different facets of bonds, but just to give you a high-level overview. Stock represents ownership of a company. If you go in and you buy a share or shares of a particular company, you are part owner of that company. A bond represents debt of a company. Let's say you have a chunk of change, say maybe $1,000 or $1,400 that you just got from the government, and you decide to take that $1,400 and loan it to a company or to the government. When that happens, you're loaning them money, and the way that is set up is called a bond. Bonds can be issued by a private or public company. There are a lot of private companies that need money for some reason, and so they get together with the right kind of people, and they decide, let's create a bond. It can be a public company. Public meaning that the shares are available at a public stock exchange, such as Disney or Chrysler or Apple or Microsoft. It could also be a municipality, a city. Maybe a city wants to build a new library or a new park. They don't have the money to do that. They don't want to tax people to get the money to do that. So what they do is they have a bond issue, or they float a bond out there. People invest in that bond, and they're given a lot of advantages for doing so. That money can then be used to build a library or a park. We can do this at the state level. Maybe there are roads or bridges or state parks or something that is funded at the state level, and so bonds are used for that. Or a federal agency such as Fannie Mae or Freddie Mac, the different agencies that overlook housing loans. There's also Sallie Mae that oversees student loans. And then the federal government itself. You may hear this referred to in some writings or by people as sovereign debt. If a country is an independent country, such as the United States, that is a sovereign nation. And if that nation is looking to issue bonds, the people that buy those are buying sovereign debt. Bonds also trade publicly, usually in Chicago. Most stocks trade in New York and then through the NASDAQ system, which is computer-based. But bonds will typically trade in Chicago and can be bought or sold on various exchanges through brokerage accounts or directly through government programs. There is a website that you can go to and you can buy government bonds directly. Some people don't really like doing that. They feel that maybe there's something they don't know, so they do it through a bank or they do it through a brokerage outfit or some other mechanism. So how do bonds work? An entity, whether it's the government, whether it's a company, whether it's a city, they need to raise money for something. It could be to build a factory. Let's say it's a company that you work for and they want to expand, or maybe the factory that they have right now is very outdated and they want to build a new one. They don't really have the money for that. So they decide to finance that using bonds. Or to build a library, as I mentioned earlier, some kind of a public place where people can go. To improve the roads, it's kind of nice, unless you like bouncing up and down as you drive up and down your roads. Or to buy another company. Some companies will raise money in order to purchase another company. And if you've heard of Michael Milken back in the 1980s, who ended up going to jail for a while, he would do this. Really what got him into trouble was insider trading. But he would raise money and then use that money to take over companies, usually in a hostile takeover, because the company didn't want to be taken over, but he would sneak around and buy shares of companies and then have a majority stake. He would become a controlling shareholder in that company. And I don't mean to single him out. It's just there are people that do those things. Rather than use money that either a government usually doesn't have, let's say a profitable company, they say, well, we don't really want to deplete our cash reserves right now building that new factory. Let's use a bond instead. So a bond is created to raise money for the particular purpose that they've defined. This is typically used as an alternative to bank loans. If you have a factory, a big factory that's in a small town, and you want to go to your building and loan and talk to George, they're probably not going to have enough money to do that, especially if it's a small town private bank. This is used as an alternative for that because there's a bigger market and you're likely to get more people actually participating in the bond. When a bond is first created, just like an IPO, that's when a stock is first created, when new bonds are created, that new debt is issued in the primary market. That's when it is born, so to speak. Most of the bonds that we talk about now, whether they're corporate bonds or treasury bonds, and they trade in Chicago, that is called the secondary market. Like most stocks trade in New York, most bonds trade in Chicago. So why would somebody want to even invest in bonds in the first place? You want to loan money to somebody so that they can build a factory or a library or something? Well, all benevolence aside, there are some other enticements for being involved in bonds. In return for loaning money for a specified period of time, that's usually how bonds are set up. They have a maturity date. So when you loan money, it's for 2 years or 3 years or 10 years or 30 years. You receive interest. You're not only going to get your investment back, well, you're going to get interest either during the time that bond is being used, or you're going to get compensated in the form of interest by getting the full face value of that loan back to you. And I'll explain what that means more here in just a second. Typically, the interest rate is established when the bond is created. They look at the prevailing market conditions. They look at the overall health of the company or the entity that's issuing the bond, and they come up with an interest rate. And that will stay the same as long as the bonds exist. So let's say you get into a primary bond and you don't ever sell it. That interest rate will stay the same for the duration of that bond. And then when that bond matures, you'll get your capital or your principal back. However, this can vary, and I'll talk about some variations of that. Generally, the greater the risk an investor is willing to assume, the greater or higher the interest rate. So if you have a company that's speculating about something, maybe taking over another company, or maybe they're involved in an area of technology that's not really mature, there's a really good possibility of getting a good return on that. But what if they dig a well and there's no oil? What if they create a product and it doesn't work, or it doesn't become very popular? In order to entice people to loan them money, they'll usually offer a higher interest rate. So it's risk versus reward. If you want no risk, you're going to get little reward. If you're willing to take more risk, then the potential reward is also there. Bonds are rated by different rating agencies. And if you ever saw the movie The Big Short, you might think, I'm not so sure about that. But the higher quality, the lower the interest rate. The main different agencies out there include Standard & Poor's. There's another company called Moody's, and then another company called Fitch. And if you're looking at investing in bonds, you might want to see what each of these companies has to say, if anything, about a particular bond. They'll usually have a rating of that bond on their defined scale. So it might be AAA according to one company, but it might be quadruple A according to another company, or B+. They use some kind of a lettering system similar to the grading system that we use. Bonds that are rated below a certain rating, usually if it's B- or below with Moody's, those are referred to as junk bonds, or high yield bonds if you want to be financially correct. Now we talk a little bit about maturity. Bonds have a maturity date. If you have a 10-year bond, I bet you'll never guess how long that bond lasts. 10 years. 30-year bond, 30 years. Yeah, there is some things in life that make sense. If a bond has a maturity of 10 years, the bond issuer promises to pay back all of the borrowed money when the bond matures. So they get to use that for that period of time, whether it's 3 years, 5 years, 10 years, 30 years. An investor, which is also referred to as a creditor, will not only receive all the money back, they will also receive the interest rate that was promised when the bond was purchased. You might get that during the course of owning that bond. It may be paid back to you all in one lump at the end. Different bonds do things in different ways. There are variations, such as zero coupon bonds or discount bonds. Just to give you a real simple example, when I was young, one of the gifts that I hated getting, but I really appreciated when I was older, were savings bonds. And I would get a $100 savings bond or for my birthday or special days. When my parents went to the bank, they didn't pay $100 for that bond. And just to keep it simple, let's say they paid $90 for that bond. In 20 years, because I was supposed to wait and save that money for education, I get $100. So it's a discounted bond. They only had to pay $90. But if I held on to that for the whole time, then I get $100 back. That's one form of compensation. Other bonds, you give them $10,000 and then you have an interest rate that you receive every quarter or twice a year or once a year based on how that bond is actually set up. So why do we invest in bonds? As a general rule of thumb, many investors decide to manage a portfolio using different investment vehicles during different stages of their lives. You don't invest the same way when you're single and in your 20s as you do when you're in your early 60s and getting near retirement. There are different seasons of life, and so we need to invest things in different ways depending on what's happening. Typically, stocks are used for capital appreciation, use that for growth, and are often seen as riskier than bonds. You might hear this on a day-to-day basis if you turn on some of the financial channels. When stocks are going up and bonds are going down, that is called risk on. Stocks are usually considered more risky than bonds. And it might even change. It might start out as a risk on day and then switch to a risk off day later on. As one enters retirement, stocks are often replaced by bonds. So you might spend 40, 50 years of your life building up a nice portfolio, and then when you get ready to retire, you switch from stocks over to bonds. And then the interest that you're paid from those bonds can be used as income. And when the bond market is doing very well, in fact, doing better than the stock market, that is called risk off. There's always risk involved. So these are just terms that people use to describe what's happening in the market. Bonds can tank and stocks can tank. So just be aware of different terms that are sometimes thrown out there to give us some kind of meaning about things. Interest payments are different than dividends. One of the decisions that a lot of investors will have to make is, I've got this really nice portfolio of stocks. I'm getting ready to retire, or I have a nice portfolio. I'm not ready to retire, but my kids are getting ready to go to school. What should I do? Should I take out that money from the stock market where I might see some real losses if we hit difficult times? Okay, then what do? Do I put that money into bonds where I get interest from that? Or do I put it into stocks that pay high dividends? What's giving me the better return? What are the tax implications? What are the capital gains that I have to deal with? These are different questions that investors should ask, and a lot of times will seek out the advice of a financial professional, of which I am not one. I'm a teacher just trying to teach you about these things. My hope is that if you do use a financial advisor, these videos that you're watching will help you be more informed, so when you do meet with that person, you'll understand more about what's going on and you know better questions to ask them. There is a risk of default. What if they can't pay their interest? We hear about that every once in a while. Greece can't make its interest payment for this quarter. So far, the U.S. has been able to avoid that. But other countries, sometimes that date comes up and they have to pay the interest on the bonds that they've issued, and they may not have the money. A company may run through that same problem. That's just happening now as I'm recording this video. There's a real meltdown of a hedge fund that you're probably hearing about in the news, but it might be old news by the time you hear this. A large part of the domino effect was that one of the investments of a hedge fund, they were not able to make their payments. And that sent things into default, which is then bled over into the hedge fund itself and has created kind of a mini catastrophe and a major catastrophe for the investors that are involved. So bonds can also have default risk. Just like when we go to a bank and get a loan, the bank is taking a risk on us. That's why we have to pay them interest. But there's always that chance that we may not be able to pay that money back. When we loan money to an entity, there's a chance that they may not be able to pay us that money back, let alone the interest that is due to us. When a bond is issued, there is a risk that the issuer will not be able to pay the amount that was borrowed, or in this case, the bondholder. There's also a risk that interest payments may not be able to be made. This is just a fact of life. The greater the risk of default, the higher the interest rate will be. That's not the only factor that plays into the interest rate, but that's a large part of it. It might be that this money is being used for something that's pretty risky. As with stocks, bonds have different levels of risk. So thank you very much for taking the time to watch this video. I really appreciate that. If desired, please click the like or dislike below. You're welcome to vote. The thumbs down crew is welcome to show up if they like. Please leave any comments. That'll really help out. And I try to stay really on top of those. I appreciate a lot of the comments that I've received so far. If you have questions, if you have suggestions, if there's something that I explained that you didn't quite understand, please let me know. If you want to know more about the program that I offer, please feel free to ask me. Also, consider subscribing to this channel and clicking on the little dingy bell right below this video. Then you'll be notified when I post new videos, and I'm trying to post about 3 each week. Please access the free workshop that I talked about at the beginning of this video. So with that being said, thank you again, and I'll see you in the next video.